Good morning, Traderfirstyear here. I know it's been a while since I last posted a video or recommended a trade. So I am recommending a new one. This is going to be a 510 2020. Again, it's for market open on 511. It is a very bullish overall outlook. New options trade. Sell 4% to 5% strangles on indices, puts and calls. Traders will be long theta and short gamma to take advantage of fall in implied and realized volatility. Expected outperformance. Be very wary of left tail risk. Want to avoid the small print. Condensed version of the trade is pretty straightforward. It is a short vol via short front dated options and a short gamma profile. Volatility expectations. I expect the market to move less than 5% plus or minus this week. VIX expectation is for a 2.2% to a 1.57% move, which is 25 to 35 on the VIX, and a Volga on the VVIX of about 3 to 5 points plus or minus this week. Range on S&P 500 via VIX is between, again, like I said, 25 to 35 this week. The full summary and rationale for the trade. Overall, equity valuations remain extremely stretched. We are witnessing financial engineering on steroids, which has led to very large multiple expansion. The market has continued to ignore the $1 trillion drop in national income, the subsequent fall in corporate profits, wages, and the increased upward rate of national savings. This is being experienced at both the corporate level through drops in capital expenditure and also the household level with drops in consumption. Aggregate demand, in particular health services, which account for 18% of personal consumption expenditure. I believe the drop in national income in the US as well as globally will continue to exacerbate the growth in US income versus the rest of the world. These differentials in real interest rate yields and less negative pace of US national income growth will likely engender a continued appreciation of the US dollar, which will continue to further negatively impact US equity valuations in the medium term. However, the weaponization and pace of the Federal Reserve balance sheet expansion has proved considerably hard to fight. At some point, this will give way to a very large market correction. I'm not sure when this will happen. So while this backstop continues to reduce the overall level of negative gamma and convexity in the market, traders will have the ability to profit from it. I am recommending traders profit from selling elevated convexity into the market via put right, call Write Strangles, which are 5% out of the money. Traders will assume the role of insurance companies for a week, selling premium, writing policies, and keeping the profit at the end of the week. Brief on the trading suggestion. We will temporarily be in a period of reduced swings up and down, and there's probably more delayed selling likely to restart, but I don't know when that is, so it's to be determined. The rationale for the trade. The market will remain relatively range bound this week in comparison to the 5 previous weeks. This will present traders with the perfect opportunity to profit from selling volatility back into the market. A low return environment and possible negative curve with Federal Reserve balance sheet expansion as a useful backdrop invite investors to re-engage temporarily in seeking to exploit timely carry trades by selling volatility back into the market. The risk for the trade. The risk is any large increase in realized volatility which causes the US equity market to move up or down greater than 5% to 7% this week. This would create substantial problems to the right or left side of the distribution curve. What we would like to happen is for the movement of less than 4% and greater than negative 4% for the week. Naked options require level 3. And I'm only recommending indices, the Spider, the Qs, and Dow. A current update will be available after trading opens on Monday. There is an additional addendum here and economic risk for the trade. The U.S. economy is very dependent on the growth rate of the big 6 states. They represent a little more than 45% of real or nominal output. These states would need to grow to 5% for the full year to fully offset the $1 trillion drop in national income. This does not seem possible. However, the Federal Reserve has proven to be a formidable opponent to rationale, logic, and proper equity valuation. Until they decide to go back to the free market economy, equity valuations and real economic performance are likely to differ significantly. When you take a look at the list of the 6 states, you can see that they generate a total of $9.6 trillion out of a total of $21.7 trillion for the US. That's about 45%, and you can see the breakdown. Last year they grew at about, on average, about 2.5%, which was a little bit above trend. If you do the weighted average, they contributed about 1.21% of the 2.3% of growth that the US experienced in 2019. These states could further exacerbate or significantly lessen the $1 trillion drop in US national income, but it would require them to grow at rates which were far above their 2018 and 2019 performance. This, as of today, does not seem likely to happen. Therefore, the drop in national income is likely more sustained for 2 or 3 years, which means a market trading with a forward PE of 20 to 30 is grossly overvalued. I appreciate you listening. If you like the information and the content, make sure to become a Patreon and go on Stock Tweets, follow me there. Go on Instagram, you could follow me there. And as you know, you can follow me on Reddit. So take care, enjoy Mother's Day, and thanks for listening.